Welcome back to the ET Money Show. Santosh Iyer, the sales and marketing head of Mercedes-Benz India, has hit the headlines with his statement that systematic investment plans, or rather SIPs, are preferred investments over buying luxury cars like Mercedes. Now, if you look at data from AMFI, that also suggests that retail participation in Indian equities markets are at unprecedented levels and is likely to stay on the upwards trajectory going ahead. Is there actually a change in the trend? Is save early and own a Mercedes later the new investment mantra? And will SIPs and the magic of compounding help you buy your dream Mercedes? To discuss all of this, we have on board Mr. Chethan Shenoy, who is the Director and Head Product and Research at Anand Rathi Wealth Limited. A very good evening, Chethan, and thank you so much for joining us today on ET Now. Since morning itself, this headline is making rounds that SIPs is something that is actually threatening the sales of Mercedes-Benz in India. And we have seen in the past that SIPs are at record high levels. But coming to you, you have been analyzing the portfolios of these HNIs over a period of time now. What Mercedes-Benz India management and team is saying, do you agree with that?
Thank you, Srishti. I think this is indeed the hot topic of the day. We've had several Twitters and Twitter statements being passed, etc., on this specific topic. I think what the gentleman who heads one of the German car companies is saying is the growth that is likely to be seen in the luxury car segment, while they've seen good growth, especially after the pandemic, is currently being capped by the amount of by SIP as a competition. So the competition for growth for luxury cars is coming from the SIP segment, and that is capping the exponential potential of growth in the luxury car segment. So, and I completely agree with this gentleman. This is a trend that we are definitely seeing among HNIs. I think there are four things that are happening as far as HNIs are concerned. Number one, the decision making on investments have started happening a lot more mathematically and logically rather than emotions and narrative driven. So that's the first change that we've seen in HNI behavior. The second change that we've seen in HNI behavior is there's a preferential for financial assets over physical assets. That's the second change that we have seen in HNI behavior. The third change that we've seen in HNI behavior is they are choosing experience over ownership. And the fourth change that we are seeing among HNI behavior is there's a preference to financial freedom rather than ownership and security of having physical assets. Financial freedom has taken the front seat. So these are four changes that we are seeing, Srishti, among HNI behavior.
I understand. So the clear trend is that the SIPs are gaining more traction. But when it comes to the sales of some of these luxury brands, what is your sense on that in terms of, because you have been analyzing the portfolios, if you can help us with some math for our viewers in terms of going ahead, how can they benefit from having a good amount of return when it comes to investing in some financial asset or securities? And rather than that, if now they choose to own a Mercedes or any of the luxury cars, how the money will grow in terms of maybe in the same time period? What's the maths looking like?
Yes, definitely. I think it's definitely a dream for most of us, or all of us for that matter, to own a German car or a Mercedes for that matter. Definitely is up there when it comes to aspiration to own a luxury car. A few things before I get into the math of it. I think we just saw the SIP numbers. The SIP numbers are clearly indicating this change in behavior. It's gone up from, over the last 7 years' time, the SIP book in India, SIP savings in India have moved from 3,500 crores to close to about 13,000 crores. That's about 3.5 times increase. So clearly showing a trend in behavior among HNIs. Why is this happening? I mentioned to you the math, and I will just therefore get into the math of it. The math of it is very simple. Even if you are expecting a return of, say, about 12%, while In the long term, the returns have been between 12 to 14% as far as equity is concerned. If you're expecting a return of about 12% on your savings through SIP format, and if you're intending to buy a car worth of about 75 lakh rupees, I'll first give you the mechanism to look at what would be the difference between buying a car today and paying an EMI. So if you're a car worth about 75 lakh rupees, that's the bare minimum that you'll have to, if you're buying a brand new car from one of these German manufacturers, which will come to, say, if you pay interest of about 8 odd percent on the car loan, your EMI will turn out to be about 1 lakh 17, 1 lakh 18,000 rupees per month. Now, if you take a 7-year loan, right, in exchange to that, while that's option one that it's available to you to buy the car today, in exchange to that, if you save that 1 lakh 17,000 rupees per month in the form of a SIP, expect that to grow at the rate of about 12%, like I said. You can see that amount being about 1.5 crore rupees by this point in time. So the difference between the two is in option one, you would have bought the car. After 7 years, the value of the car would have depreciated naturally because a car is a depreciating asset. It's not a appreciating asset. So say a car worth 75 lakh rupees after 7 years, depreciating at the rate of about 10% or so would be valued at about 35 lakh rupees. So on one hand, you have 35 lakh rupees on the 75 lakh rupees of a car, and on the other hand, your SIP of 1 lakh 17,000 rupees has become 1.5 crore. So the difference is of 1 crore 15 lakh rupees. So that's the math, so to say, Shrishti.
Well, yes, I will not be glad if Mercedes has also done this kind of a maths and then after they are making such kind of a statements. But Chetan, coming to you, like you have been mentioning that owning a German car is a dream, right? But if somebody is planning to own a Mercedes, what should be the investments looking like? How can one make money work for money, like making money from money? How that will work if I want to have a Mercedes in the times ahead? How should my investment journey start for that?
Absolutely. I think you have hit the nail exactly where people are wanting to understand how, if I want to own a Mercedes or a German car, what is the kind of savings that I need to do? And we get this question a lot from HNIs who want to either buy the car or need to plan to buy the car. I'll just give you a rough math. If one is to buy a car using the same example, while 75 lakhs probably is one of the lowest ends that you could buy a decent good car for Mercedes C-Benz, C-class kind of a car. We would say that the math basically is that you will have to pump in or save for the next 5 years time. You could start with a SIP of about 1 lakh 20,000 rupees per month. So if you do a 1 lakh 20,000 rupees of savings per month for the next 5 years time, you would have an amount of about a crore. And why am I giving you a number of a crore instead of 75 lakhs? Because the car will also inflate. Please remember, luxury cars will inflate at a certain rate, and I would assume that it will be worth at least a crore of rupees. So if you want to buy a car which is worth 75 lakhs today, after 5 years, you'll have to plan to imagine that the car will be worth 1 crore, and therefore you'll have to save 1 lakh 20,000 rupees per month to buy that car.
I just hope that this discussion help our viewers get an understanding what is actually preferable, either SIPs or Mercedes. But definitely, owning a car is a dream, and one can actually not replicated with some investments. Both are actually necessary to enjoy life. But when it comes to investing and dreaming for a Mercedes, so 5 years time per month an investment of 1.2 lakhs and you can actually own your dream car in the next 5 years. That's the advice coming in from Chetan. But thank you so much, Chetan, for helping our viewers have a good understanding on the investment part of it and the spending part of it when owning a dream car. Well, let's move forward with our queries section. And for that, firstly, let me have and take the query of Rajneesh. He says that he's investing 6,000 rupees per month in equity mutual funds, and over the next 5 years, wants to take this monthly investment to around 10,000 to 15,000 per month. He is currently investing in three mutual funds. That is Nippon India Small Cap Fund. The other one that he has with him is HDFC Flexi Cap Fund, where he is investing another 2,000, and Kotak Emerging Equities another 2,000. Should he hold on to these funds when increasing his monthly investments, or he should try different options as well? What's your advice?
Thank you, Rajneesh, for this question. I think number one, congratulations that you have a SIP going on right now. Number two, I'm very, very happy to hear that you intend to increase your SIP, which means that you're sold on to the idea of saving more money in the form of SIP, which means your experience must have been good so far. Coming to what you're doing right now, the three funds that you're doing right now, all three funds are pretty good. No complaints about any of those funds. You could continue doing SIPs into those three funds. Having said which, one of them is a small cap, one of them is a mid cap, one of them is a flexi cap. I would say if you're going to add more, then diversify it a little further. It's a good idea to have at least 6 funds coming from different fund houses to diversify your risks, because please remember, small caps have a higher risk. If you have to measure it in the form of standard deviation, you can go measure it. Look at the standard deviation in the fact sheet. You'll see the standard deviation, which means the volatility of small cap is going to be higher than mid cap, and mid cap is going to be higher than large cap. So please add in a few schemes to your current portfolio if you're going to add new money into the SIPs. I would definitely recommend that you could add a large cap fund to reduce the risk. You could add a Franklin Templeton Blue Chip Fund, for example. You could add a Contra fund in the form of SBI Contra. These two funds should be a good addition to your current portfolio. Thank you.
Then the next question coming your way is from Deepak. He says that he has been investing in mutual funds for 6 years now and have collected a corpus of rupees 3 lakhs. But going forward, he wants it to increase it to 20 lakhs. That means additional 17 lakhs in the next 10 years for his son's higher education is something that he's looking forward to. Currently, he's investing rupees 30,000 per month, and that is into SBI Small Cap Fund 10,000, SBI Magnum Mid Cap Fund 10,000, and Quant Small Cap Fund another 10,000. So clearly, small cap and mid cap 10,000 each is something that he's putting on, but another 10 years and 17,000 to be added on. What's your advice coming in? Will these funds serve the purpose, or he wants to increase the allocation to some other funds as
well? Yes. Deepakji, thank you for asking this question. First of all, once again, for you, I would say congratulations. You crossed 6 years, which means that you must have already experienced what equity is capable of doing. You've seen through a market cycle of up and a down and a up again. Which should bring in a tremendous amount of confidence and experience that will help you have a larger amount of money saved into equity through SIPs. Now, coming to answer your question on two things. Number one, you are doing a SIP into 3 funds, and will you be able to achieve your objective in the next 10 years' time if you are going to save this kind of money of 30,000 rupees a month to achieve a 20 lakh rupees of savings in the next 10 years' time? Yes, you should be able to. Having said which, I would still want you to please note the following. Number one is all your funds are small and mid cap, which is something that I would want you to be a little cautious about. Small cap funds, especially you have 2 small cap, 1 mid cap fund. Small cap funds have a higher standard deviation. They are more riskier, which means during a downtrend of a market, you'll see a small cap falling more than a large cap and a mid cap. You would have experienced this in the previous cycle as well. So I would therefore say, look at diversifying your portfolio a little more and start bringing in a little more of flexi cap and large cap funds into your portfolio. You could bring in a HDFC flexi cap into your portfolio. You could bring in a Franklin Templeton Blue Chip into your portfolio. You could bring in an Invesco multi cap. So diversify your portfolio from 3 to probably 6 or 7. Point number one. Point number 2, bring in flexi cap, bring in large cap to reduce the risk of your portfolio. Point number 3 is you'll definitely be able to achieve your objective. Having said which, please try and look at this one thumb rule that we've been applying with all our client portfolios. Try and increase your SIP by about 10 to 15% per year. So if you're going to save 30,000 this year, try and get to 33,000, 34,000 next year, and that will definitely help you achieve not only this objective many other objectives. Thank you.
So those are the funds that you can be looking out for, and just try to increase your allocation to these mutual funds. The last question coming in from Roshan, and let's take up that. He says that he's just 15 years away from his retirement. So far, most of his investments are in fixed assets like PPF and FDs, but now he wants to make it a shift and invest part of that money in equity mutual funds. His target going forward in the next 15 years is to build a corpus of rupees 50 lakhs before he hits the retirement, and he wants some suggestion how much money should he invest in which mutual funds. And for now, he can looking to shift 20 lakhs from his fixed assets as a lump sum into equity mutual funds. So, Chetan, what's the advice coming in for him?
Thank you, Roshan. I think you have asked the question at the right time because if you're looking at making an investment for 15 years, it's definitely equity that you should be looking at because equity in the long term has ended up generating 13-14% return, as you'll be able to see yourself. We would definitely recommend that given that your investments are largely in fixed income, which is fixed deposit and provident fund, nothing wrong with them. Please understand that it could be a part of your portfolio, but having your entire money in these instruments, which at best can generate you about 7% return, is therefore going to cap the growth potential of your portfolio. Therefore, to answer your question on what portion should go into equity, you have given us a number of 20 lakh rupees. So let me just tell you what will happen if you currently allocate 20 lakh rupees out of your fixed income savings, which could earn you 7% and allocate it into equity portfolio. If you're able to grow it at the rate of 13-14%, which, like I said in the past, one has been able to achieve, in the next 15 years time, you will be able to get this 20 lakh rupees to become about 1.2 crores. So in the process, you'll end up achieving your retirement number that you put in of 50 lakh rupees. I would say you're better off with planning for a crore or so if you're thinking 50 lakhs is what you need, because like we mentioned several times in the past, at the cost of being repetitive, I'll repeat that inflation is a number that we don't take into consideration when we do such calculations. So 50 lakhs of today will easily, in the next 15 years time, will need you to have more than a crore of rupees. So 20 lakh rupees going into equity at this point in time, growing at the rate of 13-14% will be able to help you have the purchasing power of 50 lakh rupees after 15 years and therefore get to about 1.1, 1.2 crore rupees. So that's the answer for the question number one. I'll just want to conclude with the name of the funds. Like I said, diversify it across 5-6 funds. Don't be focused on about 2-3 funds, and diversify it across multiple asset classes. So you could look at a HDFC Flexi Cap, you could look at Kotak Emerging Equity, and Blue Chip, and probably a SBI Quantum.
Okay, thank you so much, Chethan. It was great having you on the channel. Thank you so much for helping and advising our viewers on their portfolio queries.
Thank you, Srishti. Lovely having you come here. Thank you.
Okay, viewers, this brings to the end of the ET Money Show today. Hope you enjoyed it. But with this, it's a goodbye from me and the entire team who put the show together. Thank you so much for watching.